Good morning, everybody. It is Ask Me Anything Friday, where you get to basically have a one-on-one with a professional investor at no cost to you and let me help you out in any way that I can. So I'm going to go straight to it. Corey saying he's excited for the new updated trading plan. Me too, man. In yesterday's trading room, we actually showed a trade in Nvidia that was a small loser in my old trading plan that would have been a very, very nice big winner in my new trading plan. The same trade, the same entry taken one day different, but the exit being tremendously different, hugely different. So I'm very excited for it as well. MT, good morning, all. I see an order block on weekly charts, but not on daily. Should I pay attention to them? And when should weekly charts be used? So that's a great question, right? So I I don't want to discount what you're saying here. I like the idea of having multi-time frame confirmation, right? Um, by the way, what are y'all drinking this morning? As you know, this is the Texas Pecan Blend uh roast from HEB. Um, so I don't think you're doing anything wrong with that. What I would say is figure out what time frame you want to trade on. Do you want to trade on weekly candles? Do you want to trade on 5-minute candles, right? Do you want to trade on daily candles? That's completely up to you. I would say figure out what that point is and just only focus in on that, right? I don't mind jumping into a 5-minute candle if I'm looking for option pricing to get filled, but I will tell you the amount of times I look at weekly candles is almost nil. I will every once in a while, but almost nil. Um, Now the order blocks, that's a great question. Let's actually go into a chart and we'll take a look at that. All right, so let's zoom out. This is on Nvidia. This is that trade that I was talking about yesterday. If we go to a weekly chart, actually, let me clear all my notes here. Let me remove 17 drawings. Okay. If we go to the weekly chart, where's the weekly? Down here. Right, there is going to be one big ugly order block right here. But if we do a side by side, so on the left is weeklies, on the right is US government bond 10-year yield. Let's go to NVDA. And this is on the 1 day, right? It's going to have very different order blocks. There could be some alignment, right? There could be some alignment down here to down here. But really, the order blocks are showing you where the big swings are happening. And those are where people are getting stuck, buyers or sellers. And so they're not always going to align, right? And if I go into a 5-minute chart, it's not going to align with the daily chart. Oh, I meant to do it on the left-hand screen, but either way, you get the point here, right? There's order blocks all over the place, right? So in that, my long answer to a short question, which I really appreciate, MT, is figure out which chart works for you and just roll with that. Just roll with that. So Andrew has a question, probably a silly question, but does an 80 delta call option give you approximately an 80% chance of probability or profitability, or an 80% chance of the option still being in the money at expiration? So the second half of that is correct. Is an 80% probability of that happening at expiration. In fact, the video we did just a couple days ago, in fact, I will recommend you go to this video, go to the view full playlist. Options Delta Explained. This one we did just a couple days ago specifically worked on that question. But to your question, it doesn't necessarily say we're going to have 80% probability of profit, right? We can't decide if it is or isn't going to be profitable. It is saying there's an 80% probability of it being in the money at expiration, which is what we want anyway. We're starting in the money. We want to stay in the money. We want to go deeper in the money. That's really, at the end of the day, how I would look at it. Art, the senior Wahoo, says, with trades potential being held longer, will you look at an option strike longer than 21 days? Maybe, but unlikely. I mean, 21 days, we'll just use this AMD options chain to start with, right? 21 days is my ballpark where I start, right? If I start at 21 days, I would come here and I would say, okay, at the 80 delta ballpark here, there's no liquidity. So I wouldn't be going there anyway. I like to look at one earlier. Still no liquidity. I want to see at least 250. And then I go one later. Okay, we've got some around the 144 strike. We've got 403. I would most likely go for that one. But let's say, for example, that none of these were really that liquid. I would then go out further, longer in time, And then you can see where all the liquidity is, right? Tons and tons, and thousands of contracts. That's where I would be heading. So I'm certainly not going to go any shorter, and I never would really anyway, but that's my plan. And if we need to roll out and up, by all means, we can roll out and up. It's not a big deal. It's a great way to reduce risk. Gas trader, what is the maximum positions we should hold at one time? Well, that's really up to you. That's really up to you. I years ago, I had somebody with a $3 million account send me a screenshot of his account, and he's like, "Okay, what do I do?" And I'm like, "Bro, first off, you have like 70 positions. You're not. Be honest here. Do you really think you can keep up with 70 positions? No, that is an impossibility. It is an impossibility." Now, one of my mentors, Mark Minervini, he would tell you between 6 and 10. I mean, in your full portfolio, between 6 and 10. Now, you can use a portfolio sizing tool, and we can do something like that right now. In fact, if you want, let's see. I need to find where that link went. We have a new portfolio sizing tool. We have a new portfolio sizing tool. There we go. All right. So these are just loaded in already. And what we can see over here shows how much it would cost in percent of your stock portfolio, right? Some of these are over 100%. Some of these are 200%, right? These are pretty crazy high, right? Now, if you were to trade options on these, totally different story. So let's go pull the option prices on several of these. So let's go to like Rocket Lab, RKLB. And let's go, we'll just stick with this one here. We'll go to around the 80 delta. Where did the deltas go? There they are. Okay. So this one would be $9.90. Right? And if we did 990, that would mean it'd be only 8% of my portfolio versus 36% if I were to do the stock outright. Let me make this a little bit bigger so it's easier to see. And we can't go to these because they're under the 10 EMA. Let's go to Elf Beauty. Let's see how much we could get for that one. And so for that one, let's say we went around right here. What? 25? That is the most expensive option I've ever seen on a $100 stock. 25? That's unbelievable. Holy moly, 25.70. That's bonkers expensive. I wouldn't trade that at all. No way. However, you'd only be taking 4 contracts with $100,000, 5% risk balance, risk per trade. Now, the base risk per trade, where we actually want to get out, is $1,250 in risk. Okay. But we size these in a way that if something goes haywire, our max risk is 5%. Okay. So we really want to get out at 1.25, which is a quarter of that. But our max risk per trade is $5,000, 5%. So with just these two, we're up to, let's call it 20%. So generally, 10 positions or less, give or take, is where I would stick, because then you can manage those, right? It does take a lot of work to manage 10. I know it sounds like, oh, that's not very many, right? But you don't really want very many, right? One thing that Mark Minervini also taught me is like concentration is where you want to be, not necessarily diversification. Diversification is his thing, right? If you want a diversification, just go buy the S&P 500, right? You can spread your money across 500 stocks, and you're going to get average returns in the markets. But if you want outsized outlier returns, you need to be concentrated in stocks that are moving and having outsized outlier gains. So concentrating in those type of stocks is where you're going to make that money. Chuck asks, can you explain how to trade options successfully without too much risk? Well, first, Chuck, the number one thing you need to keep in mind is never, ever, ever sell options. Never in the history of time are you allowed to sell options. Chuck, I am removing your ability to sell options, because when you sell options, it breaks the golden rule of leverage. Never put yourself in a situation where you can lose more than you can make. When you sell an option, that's exactly what you're doing. You are capping your gains and just letting your losses be wide open, right? It's like cutting a giant gash in your arm and being like, oh, this is fine, as you're bleeding out on the floor. No. You're never allowed to sell options. So that's your first way to be successful in trading options. The second way is, in my opinion, now granted, I don't know what I'm talking about, I'm just a random guy on the internet, but I did learn this from a $1 billion hedge fund manager, is you want to go deep in the money on the options. Now let me show you why Let me show you why. I have a good chart for this. Here. When you go deep in the money options, and let's say that it's roughly 13% extrinsic value. Extrinsic value will go to zero on every stock, on every option, every expiration, every single time, no matter what. But if you have to pay only 13% of it versus buying one that's out of the money, that's 100% extrinsic value. Let's use a real life example here. I don't want to go to ELF. These are crazy options. Let's go to like Apple. Speaking of, tell me in the chat, did you buy the new iPhone? I literally just 2 minutes ago bought 2 of the new iPhones. I gotta tell you, Apple's innovation is pretty pathetic. By the way, let's compare, right? This is a $200 stock and an 80 delta is $17.95. We just looked at Elf Beauty, Elf, which is a $100 stock, 80 delta, over $20. That is a very expensive option. I'm not joking with you. These Elf options are bonkers expensive. This stock costs twice as much, and the options are less expensive. That's crazy. Anyway, let's say we went, this is the extrinsic value column. This will always go down to zero no matter what. That is the price we have to pay as options traders, unfortunately. And so if we go to this and we go to the extrinsic value, 267 divided by the price of the option, 17.95, that's 14.8. All right, so let's just change this to 14. Okay, that's the option we're looking at right here. Right, it will go down in value, but it's going to go down in a linear fashion. It's in the money, and it's only going to go down by a certain amount per day. This has 35 days to expiration. So if I have 14.9%, so 14.9%, and I have, how many days was it again? 30, that was the wrong button. Hey, what's up? Who's that handsome guy? 35 days. I mean, it's going to go down by 0.42% per day. 0.42% over each day of the next 35 days. That's what this is right here. Okay. Now, if we go out of the money, and yeah, I don't know if you can tell, but I kind of know my shit on options. I love options. They're my favorite. If we go out of the money, let's say we go to this, let's go to like this one here, the 245. All right, it's $1.58. So on the nutshell, in a nutshell, you're looking at this and you're like, well, it's $1.63, so therefore that is a way less expensive option than this one that's $17.95. Oh, is it? Oh, is it? Let me show you why that's not the case. 100% of this, 100 absolute percent of this is extrinsic value. So 100% divided by the 35 days means it's going to decline by 2.85% per day. So while my option costs more in dollars, your option, and I'm not saying you specifically, I'm saying you as a just general term, your option, if you're buying it out of the money, is going to go down by 3% per day. Mine is going to lose 0.4% per day. That's a huge difference, a huge difference. So your option actually costs 2.8 divided by 0.4. Yours costs 7 times more than mine does on a daily basis. Yet, I'm not worried about mine trying to go in the money because it's already in the money. I don't have to stress on that. Great question though. I don't know if you can tell I love options. I love options. Thanks for that question. It was a great question. Jamie, good to see Jamie. With the new plan. Okay, so let's pull up the new plan details here. So I made a quick entry cheat sheet right here and exit cheat sheet. I thought of some enhancements I could do, right? Because we always talk about the OVTLYR 9. I was gonna draw some boxes around where they fit in the OVTLYR 9. That way you're not confused. Because Charlotte yesterday had a fair point. How is this less confusing, Chris? We went from the OVTLYR 9 to the OVTLYR 16. I get it. But this also has more detail than this does, right? Obviously. But to Jamie's question, the exit points here. With the new plan, when you exit, do you close under the 10 EMA or cross below the 10 EMA? Then when do you exit? Immediately, the end of day, the following day? Great question. Let's go to the NVIDIA trade that I was talking about. And we'll go to the daily chart and we'll go to June 30th. Because this was the signal in June 30th. Where's it at? June. Here we go. All right. So the June 30th signal, which is the signal you can find in OVTLYR, for the buy signal. Why are you not giving me a vertical line? Give me a vertical line. I've clicked this several times now. Thank you. Okay, this was the buy signal. Now you're probably thinking, well, not that great of a buy signal. Look, it immediately went down. Right. Let's not get ahead of ourselves here. The sell signal came ages later, and you can see that it went up ages from there. Right. So my exit in the new 4.0 plan, which I've not named, but I do have some ideas. I do have some ideas on what that name would be. Let's go ahead and circle where entries would be. So let's just put it right there, and then exit would be right here. Right. So to Jamie's question, do you close it when it taps the 10? Like it tapped it right here. You would not close it on that day. You would not close it on any of these days until it gets under the 10 EMA, right? If you don't have an outlier sell signal, but then it closes under the 10 EMA. Now, granted, it did go up at that point. However, anytime you see a close under the 10 EMA, that is a big red light. That's why I like to color that red. That is a big red light. Something is not right. The trend is not working out as well as it was. And look what happened after that point. Now, granted, it did take a while for it to start going sideways from there, but it went to the exact same price within only the last couple days did it go away from there, right? So 48 calendar days later, it was the same price as where you exited. What? 48 calendar days later, it came right back there, right? So you actually got out well ahead of time, moved on, made more trades. So I personally exit on that date. Now, some people want to exit the following day. By all means, you do you. But that's the way I would put it. That's the way I would do it. And we'll be doing it, by the way. Theo, will you be using the updated portfolio sizing spreadsheet? This thing over here. Will you be using 5% risk on the 30K? Oh, that's a good question. I was planning on 7%. But so I like 7% because I'm okay with risk. But I always tell people, don't even think about trading 7%. 7% is huge. I know it sounds like a tiny difference between the two, but let's say we go from 5 to 7, right? We went from 13 contracts to 9 contracts. So 9 over 13, that's 4 divided by 9. That's 44% more contracts on Rocket Lab. Going from 4 to 6, that's 50% more contracts on ELF. Like it doesn't sound like much, but the position size is actually tremendously bigger. Like 44% bigger position size, even though it's 4 contracts, that's 44% larger. 2 extra contracts is 50% larger position size. I'm glad you asked that question. I'll be honest with you, I don't know right now. I probably will go 7. I probably go 7. But then again, it's hard for me to tell you guys not to go 7 if I'm doing 7 in the public outlier account. I don't know. I have to think on that one. But I'll probably go 7. That's where my gut feeling is. And we are going to win, by the way. I'm planning actually on going to a trophy store, or at least going to one online, and ordering a trophy, a US Investing Champion trophy for 2026 in the options and enhanced growth division, and putting it on the shelf. And we're going to reference it every single day. We're going to manifest the shit out of that. It is going to happen. I'm telling you, for sure. We will win the 2026 US Investing Championship in the options and enhanced growth division. Oh, you're the best, Nate. You're the best, my friend. And I got to meet Nate in real life, by the way. We had coffee together. So Mike has a question. Has the team done any back testing on options that are expire on the 3rd Friday of the month to see if the data backs up the hypothesis that those are the best ones to buy? So that is the normal expiration every month. The normal expiration is on the 3rd Friday of each month. Now, lots of stocks have weekly expirations. Some, like the SPY and the Qs, are going to have more frequent than weekly expirations, maybe even daily expirations. And then there are going to be some stocks that only have expirations on the 3rd Friday of each month. That's the normal expiration. I wouldn't say that one is better than the other, right? I care more about liquidity than the expiration. Now, we don't have the data to do the back testing. So the short answer to that is no, because we don't have the options data to do that. But at the end of the day, if you can make money on a stock, you can make money on the option, and all you're doing is applying leverage on top of that. JG, is RG comparison of stock to sector similar to market versus sector worth looking at, or just stock with heat map and fear and greed? You may have covered it, but I'm new. Thanks, sir. First off, JG, I love you. I'm so glad that you're here. Everybody say hi to JG in the chat. Type hi, JG. Very cool. Good to see you, JG. So JG is asking about RG, relative greed. Let me pull up OVTLYR. By the way, Mahesh and I are meeting today at 11:30 to talk about specifically VacLab's market breadth. So, by the way, VacLab is a rock star, and he built this super sick market breadth bookmarklet over here. Let's take a look at it real quick. So what this is doing is it's going through and it's compiling a lot of data from a lot of different places inside of OVTLYR and putting it all in one spot. I told Mahesh, we need this. This is better than what we have now. This is like hands down is better. So I really appreciate that. Keep going here. All right, so JG's question was about relative greed. So the relative greed is this. If we pull up the market, actually we need to go to the SPY to do what I'm trying to do right here to start. Let's go to the SPY. So first, we need to establish what the greed score is of the market. We want to see the greed score under 70 and rising. So we actually have that today. It's 68.96. So it's under 70 and it's rising. So that's a good start. Now we need to find a sector that has a score that's higher than 69 or 68.96. And we don't have any of those. That's the relative greed. We want to find one sector that is greedy AF. It's so greedy that it's outpacing the greed of the entire market. I don't see any of them with that score right now. So I believe that answers that question. So it's relative greed of the sector versus the market. But I'm glad you're here, JG. Okay, great question from Soho. My question is about how much percent from the buying point you're recommending to put the stop loss. So I don't recommend any percent at all. In my new plan, it is whichever is a greater amount of risk. So let's talk about it on NVIDIA right here. Let me remove the drawings. It originally was half an ATR below the current price. So let's calculate that from this candle right here. The close price here, the ATR on this date was 389. 3.89 divided by 2 is $1.94. $1.94 below the closing price on that day. Let's imagine I opened it right there. $1.94 below 152.87 or 157.82 is 155.87. So I would say my stop loss would have started at 155.87. So a half ATR allows you to size for volatility. Now, because we're using the 10 EMA as our exit point and not the half ATR as our exit point, there are times, and this is a perfect example, where the 10 EMA is obviously a lot farther away than the half ATR. Everybody agrees to that, right? Everybody can see that. Because of that, we don't want to position size to this stop loss. We want to position size to this stop loss. That's tremendously more, okay? So let's see how much more. Let's calculate from here to here is $2, all right, give or take $2. And then if we go down to here, this is, let's say $7. So it's 3.5 times as much, which means we need to take a 3.5 times smaller position. 3.5 times smaller position. And I'm very excited to do that because that's going to allow us. I know you're like, oh, well, I don't want to trade a smaller position. I get that. But because of having a smaller position, if things go wrong, it goes wrong less against us. It goes wrong less against us. And that's okay. We can let it work and let it get out here rather than getting stopped out like we did before. So that's the plan on that. I think it's a great question. So I don't recommend any particular risk percentage wise. Certainly, I want to say at least the amount of the half ATR. If it's close, like imagine right here, the half ATR would be a lot closer. Like I'm sure the half ATR would be somewhere like right there. So the half ATR would be farther away than the 10 EMA. So we're going to go at least that far or as far as the 10 EMA. All right. Mr. Keen says, does the outlier strategy work on weekly charts? Anyone trading weekly? Everything that we've built is on daily data. However, what's really cool is up here in the active signals, you can switch from active to swing, and the swing signals last longer. So that may be more your style. And actually, they have higher expectancy than the active signals do. We've been working, Scott and I, Scott, our quant, have been working tremendously hard to boost up the active signal returns, which now are outpacing the swing signal returns. But the swing signal returns are already starting off on a great point, and then we're going to optimize on top of that. So it's going to be awesome. Shane the plumber. I'm also meeting with Shane today. Chris, with such a choppy market, would you still roll currently, or would you just take profit? I would continue to follow my plan. If my plan is to roll when I hit a certain point, I would roll when I hit that certain point. That's fine if I get taken out the next day. That's super fine, right? That's totally part of the game. But yeah, it is definitely a struggle bus type of market right now. And you're not the only one, Shane, who's been struggling. I know we're hitting new all-time highs, but that doesn't mean that everything out there is just going vertical, right? In fact, it's been a very difficult market for a couple months now. Siniwahu Art says, which mug should I use for coffee this morning? My 80 Delta or the outlier flag? Certainly the 80 Delta. Certainly the 80 Delta. I love it. Let's see. Justin, have you thought about triple witching and what its effects are on post and future performance would be? We've not back tested this. It's not something that I really have been too concerned about, but triple witching and also quad witching is a thing too. So triple witching is when your monthly and your quarterly and God, I forget, there's some other it's all the expirations happening on a certain day. In fact, let's just double check this real quick. Triple witching options. Stock options, index options, and futures options happens the third Friday of March, June, September, and December. I was going to give. And then there's quadruple witching. Either way, it's not something that I've really stressed on. I think you'll be fine. Just follow your plan, right? There's so many different reasons, right? In fact, I have a great slide for this. I did steal this from Tom Nash. There's so many different reasons not to trade always. But the thing that I learned from Larry Hite, the first $1 billion hedge fund manager and one of my mentors, the original market wizards, is that if you're set up to trade, you are obligated to take that setup on that date, no matter what else is going on. And I made so much money in May, so much money in May. I believe it was May 9th to May 13th. I made so much money. And it was right when Besant, I think our treasury secretary or whatever his job is, was going to Switzerland to meet with somebody from China. And a lot of people were nervous AF that there was going to be like the worst outcome ever. But my trade set up on that date. By the next week, my account was up 30%. By Wednesday the next week, it was up 30%. It was amazing. And all I did was follow my plan. All I did was follow my plan. Let's see. So We Know FOMO says, for a smaller account size, what percentage would you recommend? Should I consider a cheaper stock with cheaper options? That's a really, really, really good question. So let's go over here and let's talk about that. Like, let's go. I like to say, if you're going to trade, start with $20,000. Now, I know that's a lot of money for some people and not a lot of money for others. But when you get to $20,000, you can position size a lot easier. It makes a lot more sense. Because, for example, if I trade a $10,000 account and I'm doing 5% risk per trade, I'm going to be limited to one option contract for basically everybody except SoFi. I'd have 2. AT&T, I'd have 5. Okay. Now let's put this at 20,000. You can see this one actually would be up at 11. This would be at 3, and most of the others would be at 1. Then if we went up to like 30,000, you can start to see that we get the position sizing more in line with the risks that we're willing to take. So to combat this, yes, I would say put a cap on the size of the stock that you're looking at. Maybe it's $75, maybe it's $50. But by doing that, that's going to allow you to find those cheaper options. And those cheaper options will allow you to have a more appropriate position size. Elsewise, let's say you went to $10,000, everything is one, right? With the exception of AT&T and SoFi. Both of those, $29 and $25 stock, kind of prove out my point. But let's say you took one contract in ELF, one contract in Google, one contract in HIMS, and one contract in Microsoft. They're going to give you tremendously different risk profiles, right? Because the ATR, the average true range, the amount of volatility per each one, in Microsoft is $7.50. But on HIMS is $3. So just right there, this one tells me it's twice as volatile than HIMS, right? And because of that, that really means you need to be taking half the position size you would on Microsoft and HIMS, but you don't have enough to do that. So the way to combat that, of course, is to find those cheaper stocks like AT&T and SoFi, because they are less expensive stocks. They're going to have less expensive options, and you can position size more appropriately. That is the best way to go for sure. It's a great question. I'm really glad you asked. Lynn, since we talked about ATRs, it seems tech has higher ATR than other sectors. Have you looked into different probabilities of changing exit per sector? I have not. It doesn't mean that there's not a better way to do it, right? I'm sure that there is always a better way to do something. There's always a better mousetrap, right? All I can say is that ATR is a consistent measure across everything because it tells you how much volatility that one stock is moving, right? So for example, MicroStrategy, the daily average true range is 14.95, which is about the same as Meta. But get this, Meta is a $750 stock. MicroStrategy is a $300 stock. So that means the percentage of this ATR, $14 on 300, is significantly more than $14 on 750, meaning that MicroStrategy actually has tremendously more volatility, right? Let's do that again. Let's say we go with, let's go with Google with a $5 ATR at 230. And Amazon with a $5 ATR around 230 means they're roughly the same. But if we go with, let's see if I can find another couple of close ones here. Nvidia is $5, $178 stock. Google is $5 and a $240 stock. So the percentage is lower on Google than it is on Nvidia. So at the end of the day, I like ATR as an exit point, as a position sizing point. And of course, like I said earlier, we have to expand that to reach the 10 EMA if it is farther away. But it allows us to know how much volatility the stock has. Okay, Phil says, did you backtest following the sell signal? Yes, hell yes, we did. Of course we did, Phil. Of course we did. In fact, that pretty much beat nearly everything. But to your specific, I'm glad you asked this question, to your specific avatar right there, would you jump out of an airplane or jump off of your ultralight right there without a parachute? No, of course not. Of course not. That's what the 10 EMA is for. The 10 EMA is our parachute. But overall, the sell signal in Outlier actually is tremendously higher expectancy than pretty much everything else that we did. The only thing we were looking for is to find where that parachute's at. Let's see. Corey says, has the deposit been made yet? No, it's not. I need to ask Mahesh. I got to meet with him today. Let me put that on my notes. Where's my money? It's not my money. Where my money? All right, cool. Make sure I don't forget that. Let's see. Justin asks, I wonder if the point of control of the day would help evaluate the strength of the exit candle. So I don't know how to add point of control on here. I knew how to do it in TrendSpider, but point of control is basically where is the volume at in the day. So for example, on this candle right here, let's say all the volume came in at 655. That would be the point of control, right? Because people are selling it when it gets above and buying it when it gets below. Point of control would be a 655. It could be, and by all means, if that works for you in your trading plan, I would say go for it. Add that in. Let's do 2 more questions. Mr. Soho says, I am using OVTLYR for stocks only. Oh, wait. I already did this one. We're going to do 2 more questions. Richard, if you hold an option to expiration, is the value always 0? Must you trade it before expiration? Great question, Richard, especially on a Friday. So I can use a demonstration here. So extrinsic value will be 0. At the end of today, every bit of this will be 0. Hands down, for sure, unequivocally will be 0. Now, intrinsic value, that's the value that we're always looking to maximize. Intrinsic value is calculating the difference between the current price and the strike price. So let's just do a quick example. So if we went for the 210 strike, it's 229.09 right now, 229.09 minus 210, because that's the strike, should be 1909, which would be the mid price between these two, which is exactly what it showed right there. That value is what you would be basically the moneyness of the option that you bought. Now, here's the thing. If you want to own the shares, you don't have to do anything. You can literally hold it in your account. On Monday, you'll have 100 shares for every contract that you have on. But that's not really how option traders work, right? You can do that, but I mean, you're still going to have to buy the shares, but you're buying them at $210 versus $229. That's where that $19 of intrinsic value is coming from. So you don't have to hold to expiration. Certainly not. I like never ever do. In fact, one of my rules is if I was holding an option and it got to 1 week from expiration, like today would be for this one right here, I would be rolling out if I can find liquidity, or I'd be closing it. And the reason being is that the closer you get to expiration, the more gamma risk there is, the more risk that your stock goes out of the money and is worth nothing, worth absolutely nothing. And I don't want that risk. I don't want that risk at all. Santanu, how you doing, my friend? I've been seeing you in the chat for a while. I hadn't had a chance to say hi. It's good to see you, Santanu. His question says, what's the difference in buying 2 to 4 months option to a 1 month option when we exit earlier based on our exit criteria? That's a great question. It's price, dude. It's all price. It's all price. Let me show you what I mean. Let's price them out. So let's restart this, and let's say that we are buying deep in the money, because I'm only buying deep in the money. October 3rd, 21 days to expiration. Let's say I went with this one right here, the 210 strike. Okay, the 210 strike, which is roughly 90 delta right now, would cost me $20.75, $20.75. Let's go out in the future. Let's go to one that's 50 days out, 49 days out. The 210 strike is $23.70. So that's $3 extra compared to the one that's 21 days out. Okay. Now the difference, as we talked about earlier, is not intrinsic value. Intrinsic value is the price difference between the current price and the strike. That is your intrinsic value. The only difference is extrinsic value. It's higher because there's more time. More time breeds more uncertainty, right? The uncertainty value is your extrinsic value. And because there's more time, there's more uncertainty. So you're going to pay more. So if this is $3.30-ish cents, depending on when we look at it, and we look over here, it is $1, right? That's the difference that we're talking about right there. So it costs you more money to go out in the future. And so we can't buy as many, right? Of course, that honest to goodness is the real difference, is it costs less money. More money out of your account is not good. Less money coming out of your account to buy these options, way more better, right? I get that. Listen, I do the broken, incorrect English on purpose. I had a coach in high school who did it. I always thought it was hilarious, so I like to do it. My family and I even had a conversation last night because my 13-year-old son, who gets embarrassed by literally just me breathing around him, was like, Dad, I hate how you say the wrong words in English. And I'm like, I don't care. I think it's funny. So Anyways, spending less money is way more better than spending more money. That's way less good. So this was a great conversation with everybody today. Thank you so much for everybody who submitted their questions. And if I didn't get to answer your question, either way, I'm super stoked that you're here. And I hope that this has been helpful to you. And if you want to learn more, I would recommend that you save time, make money, and start winning with less risk. The best way to do that is by clicking one of these two videos. We'll definitely talk soon.